Markets have slightly continued its rally. Can it continue or has it hit another wall? We go over the markets up to June 13, 2019. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on the examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against loss. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, we examine the weekly chart action of the S&P 500. We go over a former high flyer in the early rally of 2019. We examine the NYSE AD line, the new high-low line, and the bullish index. And finally, what does this mean? Our first chart is of the weekly chart of the S&P 500. The first thing to observe is that as of Thursday, June 13th, the S&P has gotten back above its 10-week moving average. That is positive news. This week, the market has shown some signs of a short-term rally fatigue as volume on up days have been low and the last hour has seen up days lose some of their gains. So despite, as of Thursday, having a positive week in price, there are still some headwinds. Despite another positive week in price, the MACD bars are still in orange, which is negative. Having bars in the MACD negative is not necessarily damaging. It is usually the length of time it spends in negative territory. So the S&P at a minimum will need to get back into green bars over the next several weeks. In this slide, we review the weekly chart of the Semi-Conductor Group. This was a high flyer for the first 4 months of the year. Then, whether it was the China trade tension or a change in sector leaders, this index has suffered. Now, unlike the S&P, this index has not reached its 10-week line as of yet. As we can see from late April, we had a peak of 1604.57 before beginning a sliding price. Now we do see a gain the week after, but the index could not pass its old high and then the steep fall began. For now, it does look like we are in a rebound since the bottom. The key will be when we have a week where the semis rally to a high of 1440.80, it could not hold and now it's at 1392.94. Let's see if this week was a short-term peak before another drop. The MACD shows us what we see in price actions. Bars are negative. Like any asset, the longer we are in negative territory in the MACD, the more this index will struggle. The first breadth indicator we look at is the NYSE Advanced Decline line. Technical traders look at this line as it shows us if stocks are advancing or declining. Now, this index has shown resilience in the face of the recent drawdown. First, we see this indicator take the 10-week line once again. It has been consistently above or at the 10-week line since mid-January. That shows consistency, which is good. But despite 2 weeks of S&P gains, this index has not shown any new buildup in strength. We can see in the MACD, the momentum indicator, that nothing has changed. Again, going negative would not mean danger, but if it goes to orange and we see pressure for several weeks, then we can see if the strength of this index holds above its 40-week line. The next market breadth indicator I would like to examine is the new high-low line. Traders consider this a leading indicator for technical analysts. It shows us the number of stocks making new 52-week highs. This indicator is still chugging along, trying to get above its 40-week line. With markets rally over the last several weeks, it is a good sign to see this line rising, as it shows more stocks are breaking old 52-week highs. So for now, if it can break above its 40-week line, that would be a great first step. But we do have to take it with a grain of salt, as the 40-week line is in a steep downward angle. We will need it to first flatten and then begin a slope up. The MACD bars for now are still in green, and that is positive. It has been showing signs of slowing down, but for now it is still in green. If the S&P can eventually get its MACD into green before this index turns orange, that will be a great sign, as this shows that a new fresh rally of new highs can continue. Our final breadth indicator is the NYSE Bullish Percentage Index. The Bullish Percentage Index is a breadth indicator based on the number of stocks on point and figure buy signals within an index. So anything above the 50 line would be considered bullish. This indicator was able to get back above its 50 line, which shows that stocks for now are bullish. But 1 week does not change the narrative of headwinds. What needs to be seen is if this is the beginning of a new bullish range or the beginning of choppy action. Positive first step, but not an indication that all is well. The MACD momentum indicator is still negative. The longer it stays negative, the more pressure on this index. As we can see, the MACD indicating late October to November, we see negative bars begin to get weaker, but could not get back into the green, and eventually a new fresh breath of negative momentum hit. The bars got bigger, which translated into major drops in the US stock markets in December. So the faster we can get out of negative area in the MACD, the better. What does this mean? The S&P as of Thursday, June 13th, has followed the previous week's gains with another positive week. Having said that, we are not out of the woods just yet. Yes, we do see the S&P price action above its 10-week moving average, and we see the advanced decline line also reclaiming that line. But despite 2 weeks of action, the S&P's MACD has yet to turn positive. It is still in negative territory, so there is a concern if it cannot get into the green over the next 2 or 3 weeks. Another concern is that despite 2 weeks of price gains, the AD line's MACD is still barely holding on to its green bars. What that shows me is even though there were strong gains in price, the strength in volume demand was not that strong. For rallies to last, you need both higher prices and also strength on the buy side. How much are institutions willing to pay for the stocks they want? Right now, demand looks tepid. So we are still in cautious territory. We have positive price and moving average action, but momentum continues to be a headwind. The quicker we can see momentum on all these indicators turn positive, then we can see a new true long-term rally. Thank you for viewing my video. Please like and subscribe to my channel for future videos. Also follow me on Twitter at my handle HRSNYC.